rising yields have been a key focus for investors here, with the 10-year still tracking above 4% now. What impact is that going to have on equity valuations and your broader investment strategy moving forward?
So, we were worried in the last couple of weeks that yields were looking too low, and we were thinking like the right number for the 10-year was about 4%. So now that the bond yields are at 4%, we're really comfortable with markets. We're comfortable with our fixed income investments. We don't think we have a lot of, upward yield risks into our bond portfolios. And likewise, I think the backdrop is really stable for equities. I think this combination of continued growth and at the same time having a path and a year of rate cuts to come, that's a great backdrop for investing for both stocks and bonds. And I think yields at the current level look right, properly valued.
You're also calling for a 25 basis point cut in November, following on from that jumbo 50 basis point move. Just walk me through your current thinking on where the Fed moves from here, why you're calling 25, and also with regards to the impact here, do you think that is ultimately going to be backed up by the Fed minutes this week?
Yeah, so I mean, just I guess in the last week, I thought the conversation was between 50 and 25, and we were saying 25 because we really think the most important discussion is what's the path to where they're going. The Fed says they're trying to get to be more neutral. And, we perceived neutral on our economic models as being something close to 3.5%, whereas it looked to us like markets were pricing that somewhere below 3%. And now that I think the market sort of changed its pricing, if they are on a path to something closer to 3.5, 3.75, then what you need is a series of 25 basis point hikes to get there. And another 50 is probably getting there too soon, too rapidly, and not necessarily needed based on the data that we're getting.